Okay, hello everyone. Thank you all for coming for today's webinar. Today's webinar will be done by me. My name is Sam. I'm from the CFD Central Dealing team. So if you happen to call the CFD hotline or the dealing desk line, there's a chance that I will pick up the phone. Me and my team will be manning the phone. So you can call us anytime, 24/5. So today, our webinar will be talking about mastering the essentials of fundamental analysis for Forex. So this will be quite a special one for people because a lot of people usually associate Forex with technical analysis instead of fundamental analysis. So today we'll be talking about the other side of the coin, fundamental analysis. So without further ado, let's begin. So first thing first, of course, we have a disclaimer. Any information provided here in this webinar will solely for educational purposes, and if you want financial advice, please go to your trading rep or other professional. So it is for educational purposes only. So today, the content page will be touching on some of the basics of FX, just so that everyone, is on the same page. We won't be touching too much, just making sure everyone knows, like, when we talk about certain currency pair, what does it mean? And then we'll talk a little bit more about US dollar as a global reserve currency and why the US dollar plays such a big role in FX, the world FX, be it, Singapore to any part of the world, and why US such a dominant have such a dominant stake in the global FX markets. Then we will talk about, what is fundamental analysis in FX. Then we'll talk about more about central bank policies and the type of FX pairs that created from these policies. Then we'll talk more about, the more headlines are all talking about interest rates. Like yesterday, the Fed decided to pause hiking interest rates. So how interest rate actually affect FX pairs. Next, of course, also the next big thing will be inflation. As you know, inflation has been high recently for the past year or two. So how inflation is able to impact FX and what kind of effect does it do? Next, we'll talk about a weekly update, with something that me and my colleague has created on a weekly basis. We'll cover more about that in a while, and we'll end with the promo, because currently we have an FX CFD promo that you all can participate, and we may end off with a Q&A. So what is FX? FX, there's a lot of different names. Some people call it FX, some people Forex, foreign exchange. They're all the same thing. They're all mentioning about a marketplace where traders, investors, businesses come to trade currencies. One key thing about difference between FX and, let's say, equities is that FX is more of a broker, a dealer-driven market than an order-driven market. So in FX, you have a lot of different dealers. So, different brokers, and so on, that offer different quotes. Even like, let's say you go out and you go to a money changer. Different money changer give you a different price. But as stock markets, let's say you buy, SIA shares, you doesn't matter which broker, usually the price is the same because they all go through the stock market. So there's one special thing about FX as well, is that it's a order driven, it's a dealer driven. So everyone can quote different price. So how do you differentiate them? Differentiate the different brokers. Next is run on 24/5. So anytime from Monday 5 a.m. to Saturday 5 a.m. as well. You can be trading FX. So the FX markets are always open 24/5. As you start with Sydney market, then it goes to Tokyo. Then when Tokyo close, go to London, then Europe, then New York. Then when New York about to close, Sydney will take over. So this cycle will carry on from Monday to Friday or Saturday morning. Yep. And another thing about FX is that's unique is it's traded in pairs. So those stocks are traded like DBS stocks, but for currencies, we always talk about FX in pairs. So it's something against another currency. So let's say US dollar against Sing, or Euro US, or USD Japan yen. So you always say in a pair. So you can't really buy Australian dollars unless you have another currency that you're willing to sell. So like AUD USD. So Australian dollar against US dollar. So always say in a pair. Next is traded on margin. Be it because we are talking about CFDs today, be it on CFD or FX, other FX products like spot markets, futures, and so on. They're always traded on margin, just how much margin. So for CFD, we're able to have a 5% margin, which means a 20 times leverage. So let's say a contract takes about $10,000 of the basic currency. You actually only need to put up 5%, which is $500 to trade this contract. So your P&L, your profit and loss will also be multiplied by 20 times. So all FX are usually traded on margin. Very rare people will trade FX not using margin. Yes, so margin is an advantage that FX traders are able to enjoy compared to stocks. You know, when you buy stocks, if you're not, you can take margin, but mostly if you buy stocks, you need to pay quite a lefty sum because your even if you take margin, you may even need to put down at least 10, 20, 30%. Well, FX you only need to put down 5% margin. So here we have a FX pair as an example. So let's say we have a British pound US dollar. So this means that the currency on the left, which is British pound, is said to be as the base currency. And the one on the right is the term currency. So in all this term, base, just remember left and right. So left and right is much easier. So let's say you're buying this pair, okay? You're buying British pound US dollar. So you're actually buying the one on the left. So it means you're buying British pound, you're long British pound, and you're shorting the US dollar. While as if you are selling this pair, you are actually selling British pound and buying US dollar. So this is how FX is traded. So when you buy, you sell the opposite. You sell the other side. So when you buy this pair, remember always buy the left and you sell the right. Then if you sell, means you sell the left, you buy the right. So it's always a buy and sell of a pair. So next, so here's an example. So usually there'll be quotes. You know, you see, they even in your money changer, they always have a quote. So what does that quote mean? So let's say this pair again, British pound USD. Let's say the quote is 1.3. So it just means that one British pound, one on the left, one currency for the left equals how many currency on the right. So it means if it's 1.3 means one British pound, it can exchange for 1.3 US dollar. And of course, if it goes up, then it's one British pound can exchange for more, 1.45 US dollar. So this means that, so let's say you long this contract, so you buy British pound, and then it went up to 1.45. Then you sell. Your profit and loss will always be in the term currency, the one on the right, even though it's quoted as one British pound is how many USD. So this is something special to FX. So if you are planning to try FX or even understand FX, these are like some of it's like the rules of the game kind of thing. So this is how FX is quoted. So and it's how FX is when you trade, how your P&L is recorded. So just know that your P&L is always in the currency on the right, or the term currency. The next thing will be there's a unique thing for FX is that there's something called a swap points. So swap points basically indicates that it recognizes that, because like we said earlier, that when you buy a currency pair, you actually buy the left and sell the right. So whenever you trade FX, there's always a currency that you buy and a currency that you sell. So when you sell or you borrow, you have to pay the currency. You have to pay the interest rate for that currency, and when you buy another currency, you actually gain the interest rate. So this swap point recognizes that there's an interest rate differential between the currencies bought and sold. So if you buy a pair that the currency that you're holding gives a higher interest rate than the currency you're selling, then you will gain swap points or interest rate differential every day, provided that you hold it to the overnight. So currently, if you hold it overnight until 5 a.m., you'll consider one day and you'll gain swap points for the day. But then if you buy a contract, a FX contract, that the short or the borrowing currency has a high interest rate than the currency that you hold, then you will pay swap points on a daily basis. So don't worry, later we'll have a very good example on this. So this is something that you need to take note of, because this is special to FX. Stocks and all this usually don't have swap points on a day-to-day basis, because all these other assets usually are based in one currency only instead of two currencies. So this is something you need to take note. Because swap points, some of our clients usually call in asking, hey, why my account keep getting money? These are swap points. Next thing, the cost in FX CFD. So FX CFD, or our FX CFD, has no commissions, zero comms, zero finance charge. So we don't even though we give you 20 times leverage, right? There is no finance charge. Then we have thin spreads. So what does the thin spreads even mean? Why should I care? So here we have a price tick analysis. So this we have the popular pairs that we have. So we have Euro USD, AUD USD, and so on. So these are our pairs and these are our spreads. So this spread, what does this spread mean? So this spread means the difference between the bid and the ask price of this contract. So if we were to open at our ask price and you sell at the bid, you will incur this bid ask spread, which is our spread. So on average, our spread, so if you look at the middle, our spread is like 0.5 pips, 0.6, and so on. So these are actually highly competitive. And I'm so confident that you even compare us with our competitors, and we will at least match them or even beat them. So with thin spreads, because there's zero comms, right? The next thing will be spreads. So as every broker with different spreads, obviously, if the thinner the spreads, the lower so-called transactional cost the trader or the investor will incur. So, and here you can also see that our US dollar counters tend to have lower spreads. So one of the reasons why is that 80% of all FX trades are in US dollar. So because US dollar has such high liquidity, so if the pair has a lot of people trading, especially like the popular currencies like Euro, Australian dollar, Japan yen, British pound, and obviously the king US dollar, then usually the spreads will be a lot thinner because there are more traders, more people buying and selling. They'll try and undercut each other, trying to give better spreads. Then that's why the spreads are thinner and thinner. Whereas exotic pairs, like let's say more harder to gain access to, from Thai baht to even some other Asian currencies, tend to have bigger spreads. So those are less trader friendly because if you buy and sell at the same time and you eat the bid ask spread, you're gonna incur higher costs compared to more liquid pairs. So that's something that you need to take note of. And of course, during odd hours, when no markets are really open, like that, after US close, maybe like 5 a.m., 6 a.m., usually the spreads are wider because of there's less liquidity. So in the end, FX is still driven by the supply and demand. So do take note. These are some of the spreads and things you need to take note when you trade FX compared to stocks. Even stocks, usually when stock market open and when our stock market about close, usually the liquidity there is the highest as well. So in the middle, liquidity is a bit less. Next, we will talk about how US dollar as a global reserve currency. So a little bit of history, just a little bit. After World War II, there was the gold standard, and then there was the Bretton Woods agreement. So Bretton Woods actually is a golf resort in US, where after the war, the allies sort of came together because they want to trade with each other. They realized that if they have a currency that keep floating, keep fluctuating, it's not good for business, because businesses, very hard to sell when one day your price is this price, next day due to FX rates, it keep going up and down. Very hard to do business with each other. So they all come together, and then they agree to have this agreement where all the countries will peg their currency rate against the US dollar. So for example, 360 yen we're able to exchange for $1 US. Then 0.3571 pounds will exchange for $1 US, and 3.5 francs, or the France currency, will exchange $1 US. Then US will make sure that its currency is pegged with the gold. So $35 US will peg to 1 troy ounce of gold. So like this, all the currency are pegged. So when you do trade, even countries want to borrow money in terms of USD, because now there's pegged, right? It's easier for accessing the borrowing of US dollars and other currencies, because everyone can expect, today and tomorrow the currency rates are the same. So back then they thought it was a great idea, until when 1971, when US or President Nixon decided to go on TV and just tell people, tell the world that they're going to stop the ability for people to convert their US dollars to gold. Because US actually was, due to US pegging its currency with gold, they are unable to do monetary policies and able to influence their economy effectively, because they peg, so they have to enforce the peg. So from there, President Nixon made a choice. Obviously everyone was not happy because the whole arrangement was very US favored, and then US decided to pull out. So obviously everyone wasn't very happy, but everyone was already using US dollar as like gold. So everyone was holding US dollar because everyone need to hold US dollar because they need to maintain the peg. That $1 US equals to 360 yen, and so on, all the other countries. So everyone was like, what the hell, Then US decided to do, so US abandoned this whole project or this agreement and decided to, allow their currency to free flow. So after 1971, the free float model, where, the supply and demand of the market decides the currency rate, is the default. Then about 60 to 70% of global reserve are still in US dollars ever since then. So because US dollar had become the global trade currency, it has the highest liquidity, and a lot of things are priced in US dollar, such as from oil to gold and so on, and commodities are all priced in US dollar. So that's why US has a very dominant. They can even, in certain cases, weaponize their US dollar as a weapon. Okay, now we will talk a little bit about the difference between fundamental analysis and TA. So in TA, a lot of clients are more familiar with TA, especially with FX. It's more focused on the price movement, chart patterns, and incorporate indicators and charting objects, lines, levels, Fibonacci, and so on. And they believe that using past price behavior, they can sort of predict or anticipate future price movement. So it's more about the price movement, that sort of dictates, some human behavioral that, they try and tap on it to sort of predict how prices are going to move in the future. while as a fundamental analysis focus more on the financial drivers and the macroeconomics. So, we are more big picture, we try to see what are the facts that we know from macro news announcements to data releases. So these are things that we, for fundamental analysis, they really rely on, because they usually draft out models, even rely on analysis reports to build a model of how, be a company, how they're going to do in the future, balance sheets and so on. For FX, be more about, how the economy is doing, the trends of interest rates, inflation, their monetary policies, and so on. So we believe that news, economic data, sentiment drives market movements. So this is a key difference. So we are going to be talking more about, all this macro stuff. So fundamental analysis in FX. So what do we look at? We look at news releases. There are a lot of data, macro news data coming out every day, and also every week and every month. So every quarter, especially the US is very good at being on time and publishing a wide range of data about the economy, from employment, interest rate, manufacturing data, to sentiment, GDP, CPI, the list goes on. There's a whole wide range of it. But of course, I'm not going to cover all of it. So we're going to focus on what I think is one of the few most important things that currently the headlines are about. And that, if you are trying to dip your toes in trying to trade FX, these are some of the things that you need to know, so that, when the time comes, that which day is the markets are more likely to violently move. If there's a huge surprise and so on, don't worry, we have even reports for you for this. So as a basics, we'll talk about the general idea of fundamental analysis in FX first. So there's something called a purchasing power parity. So short form PPP. So usually people remember by PPP. So where it defined as exchange rate should be determined by the value of goods that a currency can buy. So here we have two Big Macs. Since McDonald's is generally in almost every country in the world. So Big Mac generally is assumed as same quality. So obviously you can also use apple, oranges, and all the other kinds of products. So assume that a Big Mac in country A should cost the same as a Big Mac in country B, even though they can be using different currency. So let's say a Big Mac in country A costs $5 country A dollars, and country B it costs 12 country B dollars. So by this theory, if by right it's supposed to cost, it's the same thing, it should cost the same. Then one country A dollar should be able to exchange for 2.4 country B dollars. So this is the idea. Okay. So then we have this thing called a Big Mac index, which is it's created by the website called The Economist, which that publish a lot of economic data and a lot of commentary, and also very valuable documentary on the history and certain aspects of finance. So so they created this Big Mac index, where they used the PPP theory to try to see how countries are in terms of whether they are undervalued or overvalued compared to other currencies with just the Big Mac. So one of the example is, let's say a Big Mac in US is $5 US, a Big Mac in China is 20 yuan. So the implied currency will be 1:4. So $1 US, 4 Chinese yuan. But then compare with the actual one. So obviously the actual currency rate is not that. So the actual currency rate, according to this at this point in time, was back then was $1 US, 6.4 yuan. So it means that the yuan is undervalued because it should be trading higher. So you can use this as a way of seeing how a country's currency compared to another country's value based on goods. So what does this mean? So it means that, so here the chart on the left actually is a chart on US dollar. So obviously US dollar will be at zero because US dollar is not under or overvalued by itself. So US dollar, so if US people were to buy from any country that's below the undervalued part, it will be considered, it will be like more worth it. So it means that, you know, let's say US, they go Australia to spend money, they're able to buy more stuff with the same amount compared to they buy in US. So if we use this example, we can do it for Singapore dollar and Malaysia. It implies that, Singapore dollar, Big Mac's about $6.65. At the rate it was on 30th October, it was like 3.48. So it's about 23 ringgit, give and take a bit. But in Malaysia, if you buy a Big Mac, it's only 14 ringgit. So obviously, by this theory, Malaysian ringgit is very undervalued compared to Sing, which, according to PPP. But of course, we know that, there are a lot more factors that come into play to determine currency FX rate than just the price of a Big Mac. So the other factors that come in, obviously, is number one would be the supply and demand. So generally, supply and demand drives the currency, whether how sought after your currency is. That comes from the strength, comes from the interest rate. The interest rate affects a lot on the demand of the currency. Then the inflation also affects the demand. The central bank policy, be it quantitative easing or quantitative tightening, will affect both the demand and supply. Then obviously a supply of foreign reserve will affect the supply and so on, like economic growth, your GDP, how strong your economy is. Net importer, exporter. So countries that, let's say we are net exporter. So we sell our goods to other countries. We will want to have a weaker currency. Because if you have a weaker currency, then our goods are much more competitive compared to other countries with a stronger currency, because our goods are cheaper. Even though for us it's the same price, but for other people, their currency will be different. So net importer, exporter usually plays a big role in the central banks or even their country deciding whether they want to intervene in their currency exchange. Don't worry, later we will also have another example on this. Next, politically stability. Obviously, if your government keep changing, people don't know whether your currency one day is it valid, next day whether it's not or not. So obviously that affects a lot on whether people want to hold your currency. Next would be public debt. So of course, public debt, like US, if you have too much debt, people are worried that you're gonna start printing money to pay back, and that is never a good thing. If you need to print money to pay back your debts, then obviously your currency will not be so sought after, because you'll be just creating value out in there. So don't worry, this webinar will be covering a bit on the first four. Yep. So the interest rate, inflation, and actually the central bank policies. Yep. So first, we're covering a bit about the central bank policies. So because of central bank policies, they created different types of FX pairs. So these types are actually very unique, like the hard peg FX pairs, like the Bretton Woods. This means that, let's say, the best example would be like, the Saudi dollar will be at 3.75 of it equals to $1. So this means that, one currency is directly tied to another currency. So the Saudi Arabia has to maintain this peg. So every time that the markets, FX markets, start to deviate from this, the central bank of the Saudi Arabia will step in and adjust it back to this so that their currency can be, maintain the peg plus more reputable. Because people, like as you know, 80% of all FX trades are in US dollar. So if your currency is pegged US dollar, you will also be much more, sought after lah, because you are seen as, an alternative to US, like same thing. So much more, trader friendly, people who have a lot of US dollar don't mind to see your currency as similar. Or like Brunei dollar and Sing dollar is 1-to-1. We can even use Brunei dollars in Singapore and Singapore dollar in Brunei, so on. So, of course, this have its own issues. First, you need to maintain the peg. That means you have to the central bank has to make sure that it always maintains and have enough foreign reserve to make sure that the peg stays the same. Second, the central bank will lose its ability to intervene, to increase interest rates and so on, because their policy must match the country they're pegging with. So, so for this case, would be Saudi Arabia has to match US. When every time US increase interest rates or do anything that will affect the exchange rate, they have to do the same, or else they will risk having a lot of pressure on the peg. So some cryptocurrency has tried to do this peg, like Tether trying to hard peg to the US dollar and so on. This one is with degrees of success. So hard peg has advantages and also disadvantages. So if you are trying to trade these pairs, there's no point, because unless you are betting that it gets depegged, which it did happen in quite a few cases in the past. Next will be a soft peg FX pairs. So soft peg implies that the central bank is authorized to intervene in the FX markets to keep the value stable against a currency, usually the US dollar, or a basket of currencies. So if saying this sounds familiar to you, actually our MAS adopts this soft peg. So it means that MAS actually ensures that the Singapore dollar, follows the nominal effective exchange rate against a basket of currencies. So, they use that as a monitor. So they do intervene. So, if you're trying to trade the Singapore dollar and so on, you need to know that Singapore government will intervene not like Singapore government, Singapore MAS will do intervene when, if the exchange rate is going, beyond what they deem as, good or boundaries of the policy band. Yep. So this is something you need to take note of, especially, if you want to try and trade some soft peg FX pairs. So there are quite a few, because these are not hard peg, so they're still allowed to trade within a certain band. And MAS generally try to tell people what it is so that people can expect. But they are also not very transparent on, exactly what's their golden ratio. But generally, they allow Singapore dollar to appreciate at a certain rate against a basket of currencies. Okay, another example will be the Hong Kong dollar pegged with the US dollar. So the peg actually has a range of 7.75. So $1 US equals to 7.75 Hong Kong dollar to 7.85 Hong Kong dollar. So this peg, so even though it's not hard peg because it's not exactly a certain number, but it's within a restricted band. So of course, when the currency goes up too much, the Hong Kong central bank will intervene and be it buy Hong Kong dollars using their foreign currency, US dollar, or sell the Hong Kong dollar and convert it to US dollar. So they'll use that way to sort of make sure that the Hong Kong dollar exchange rate with USD is maintained within the band. Even though, Donald Trump tried to, says, the peg is not going to work. But, usually from the past, since the past 1997 Asian financial crisis and so on, they learned that, foreign reserve, they need a huge foreign reserve to defend your currency against speculators and people who want to depeg your currency. So from then on, a lot of the central banks has actually been more prepared. So next, lastly, we will cover another type of pair, which is what we call the positive swap points pair. So there are certain currencies that are very famous for having higher interest rates. So currently, obviously, with US keep increasing interest rates to now 5.25 to 5.5 as their Fed fund rate, that's quite high compared to back, just a couple of years ago where everything is pretty much zero. So because of this, US dollar Japan yen pair has actually been very seen by traders as a pair where they'll buy so that they'll gain swap points. Because Japan yen is famous for having 0 to negative interest rates. So that is something that Japan has able to stay whole for quite a while. So Japan basically in FX is seen as the currency with the lowest interest rates. So if you're looking for positive swap points, or what we call carry trades or carry pairs, usually they will short Japan yen and buy either US dollar or the New Zealand dollar, which also have a nickname of Kiwi. So these pairs are famous for people to hold for long term, because how long they hold it, they will gain swap points every day. So of course, even now, if you see the chart below, actually US dollar Japan yen has broke the 150 yen mark, and Sing dollar Japan yen actually broke the 110 mark. Means one US dollar can actually now change for 151 yen and above, which is quite unheard of. Quite long. I mean, it haven't been reached this level for years, decades. For Sing, never before. One Sing now can exchange for 110 Japan yen, which is, in our history, that's very worth it for Singaporeans that want to go to Japan. So don't worry, we'll talk about why. Why is it going so out of control? Why? It will be because of interest rates. Because interest rates, obviously interest rate, you benefit the person holding. But if you borrow, obviously it's the cost of borrowing. Since FX, you buy and sell at the same time. So the interest rates that the FX people that enjoys are the short-term rates. So if you have 10-year bonds going up, this doesn't really affect much to the FX markets. But if the Federal Reserve increase interest rates, because Fed usually only can influence, or central bank only can influence the short-term rates. So when they announce that they're going to increase interest rates, or they are forecast to increase interest rates, those are much more sensitive to FX pairs. So those are things that you need to take note. So short-term rates are used in FX. Fed fund rate, or for Singapore will be your SORA, SIBOR, and so on. And of course, HIBOR and so on, LIBOR. Yeah. So one of the examples will be during Asian financial crisis. So interest rates, or what we call the short-term rates or overnight borrowing, sometimes can be used by central banks to sort of defend their currency. Because during the Asian financial crisis, a lot of hedge funds were heavily shorting Asian currencies. So they devalued Thai baht, Korean won, and so on. So when they try to attack Hong Kong Central Bank actually increased its overnight borrowing costs from like a few percent to like 25-30% to punish these people. So they have to pay, suddenly they have this huge negative swap points or this carry. But obviously, doing this kind of drastic thing have consequences as well. You also harm people, mortgages, and so on. Because so they sort of learn their lesson, but there are better ways to do it. But swap points are during crisis time, central banks do have this tool to sort of play with, to sort of to play with it, to sort of like control back get back control over their currency rates. So of course, interest rate also have a effect on the economy. So interest rate, when you have interest rate cuts, then you have obviously more people can borrow money. Businesses are more willing to borrow money because their cost is lower. So you will have high economic growth, and high economic growth may lead to faster inflation. So for the past 10 years, except from COVID, pre-COVID, we have been enjoying low interest rate environments for very long. So that has actually stimulated and a lot of corporations are actually ballooned in corporate debt because it's cheap. Everyone can borrow money. Money is easy. Then during COVID, they dropped the interest rate even lower to zero. Then now we have a inflation problem. So what they do now is they increase interest rates to try to keep inflation under check, lower economic growth, so that we can fight off inflation. So it's like a egg and chicken kind of problem. So one will cause the other, but generally, what the FX markets like to see is that high interest rate is good for the currency, because I hold a currency, I get more in return. So in FX sense, high interest rate means more demand for the currency. Because let's say Japan yen 0, right? Then now US dollar 5%. Well, of course, if I have Japan yen, I would want to change it for US dollar so that I can enjoy this 5% interest compared to 0. I borrow Japan yen 0 or low won't be 0 when you borrow. Then I will go and buy US dollar for this positive interest rate difference. So interest rate and inflation are actually very linked, because we can see from this chart here. So this chart actually shows the US Fed fund rate, which is the short-term interest rate, compared to the inflation. So as inflation is high, generally the Fed fund rate will also be high. When inflation is low, then the Fed can afford to drop interest rates, and usually the Fed uses this tool during crisis. So let's say from the dot-com bubble. So if here we can see during the dot-com bubble or 9/11, they drop interest rates down straight away. During the financial crisis, they drop. During COVID pandemic, they will drop to almost 0. So that way is to sort of try and stimulate growth and sort of use it as a way to make companies not feel so much hurt during this financial crisis, so they don't have so much loan payment. So central banks tend to increase interest rates to combat inflation. So if interest rates go up, the FX will generally, for that currency, generally will go up against other currency. So next, inflation. So inflation obviously is the increased overall prices and the falling in purchasing value of money. So obviously inflation, a lot of people hear inflation, they think about the CPI, the core CPI inflation rate. So CPI generally is a term that is used more because they take into account more things, even the more things that fluctuate more volatility, like food prices, oil prices. But of course, CPI usually don't take into account the more volatile parts of CPI. So core CPI generally is seen as a more accurate way of judging inflation rate. So there are a lot of different ways to see inflation. Usually they will compare with basket of goods. So some people may think inflation is bad. Everything go up in price, who likes to pay more? Then it erodes real value of assets. Because inflation make things cost more and worth less. Your money worth less because the same amount cannot buy as much. But why inflation is good? Because if we can control inflation, it helps stimulate growth, stimulate spending, because you know that things are going to be more expensive tomorrow or next year. So why not buy now? So you incentivize people to spend and versus saving lah. Because if you save money and the interest rate is low, obviously you're actually going to lose. So generally, controlled inflation is great. About 2% inflation target by the US Fed. So obviously, if you take it to the extreme, very high inflation is very bad. Like examples like the hyperinflation in Hungary, Zimbabwe, and Turkey. But those are nowadays all the modern economies usually don't experience this. Usually we talk about like the big countries, usually they are much more on the ball and they are more fiscal what you call control. So they don't print money. Usually generally hyperinflation usually caused by people printing excessive amounts of money. Then it will devalue your currency. So currently a lot of people are still looking at the US whether they print too much, especially when they're giving away free money. So one more thing, like as I say, inflation and interest rates are linked. So if higher than expected inflation will also equate to higher interest rate for longer. So here we have a example. So on 12th of October, actually the US was set to publish their CPI data. So CPI data expected to be 0.3% month on month. But actually it came out a little bit hotter. So 0.4. So this worried people because people will be like, hey, inflation is higher, means the Fed has less likely to drop interest rates and likely to either increase or even maintain high interest rates for longer because they need to fight inflation. So because of this, the US dollar actually appreciated against the Sing after the news release at 8:30. So suddenly there's a big bar, green bar, because suddenly US dollar appreciated. So as a fundamental analysis, we see, okay, so when we have news that come out, macro news, we need to be aware of what macro news, especially inflation and interest rates that are coming out and when. So, either you want to avoid it or you want to be involved in it. So let's say you have a view. Let's say you think that you want to be part of this. You want to sort of you think that CPI is hotter than what they expect, then you will buy. But then if you think, hey, I don't know and I don't want to guess. So what you do is you can close your position or you hedge off your position so that when the news come out, right, and there was a surprise and there's a big movement, you won't be burned. But of course, you also won't get the upside if you guess correctly. So these are usually fundamental analysis believe that because of this data, that's why there's a big movement. So if you don't want to be part of it, then just hedge it off or close the position before that. So just a recap. So we have covered the purchasing power parity framework. Then we also talked more about fundamental analysis in FX. Then we talked about the types of FX pairs, be it the different kind of central bank policies that have these pairs. All these pairs have different characteristics. So obviously, if you're trading the Hong Kong dollar, US dollar, then the band is there. So it may not be the most interesting pair for you to trade. People like to trade more of the open float pairs, which is like the Euro, the US, Japan yen, and so on. Then we also talk about the difference in the hard peg, soft peg, and the positive carry. So those are some of the different types of pairs that you can consider, especially the positive carry one, which currently is quite popular. Then how interest rate and inflation actually influence people's demand of the currency, and also how certain central banks actually influence their FX currency. Okay, so now we actually have a market weekly update or weekly market update. This is a report that me and my colleague Onisha does. So it's updated every Monday morning. So if earlier you all saw like, how do you know that on 12th October they're going to release this macro news? There are a lot of websites that provide this information. Even our Poems P3 app also have a macro news calendar. So obviously you can use that, no problem. But for my report, we do it every week, and we have a commentary. We do more than just macro news. We do also market recap for last week. So we tell you about the major indices and so on. We also have essential. We feel that these are essential information for all investors or traders, be you interested in FX or not. Even if you're interested in indexes, stocks, we do welcome you to read this. We feel that after you read this, you'll be much more well informed on what to expect in the coming week and what happened last week, in case you missed it. Then we will talk about upcoming economic news release, corporate earning release, corporate earning more company specific. Then we also have TA setups. So if you're looking for trading opportunities, you want to see some TA setups, we do have it. That you can have a trading ideas that you can try, and most importantly, we always have a commentary to talk about it. So it's not a very long read, don't worry. There's also charts. So here I will bring you on to this. So currently we have this weekly update on a few websites, especially, but the one that we recommend would be the Poems. So here's our Poems website. I hope by now you all should know Poems. Then under the education, you can go to market journals. Then at market journal, we have the weekly update. Just scroll down. Then you have this weekly update. You click, then it'll be here. So we actually did this for like a couple of months. So quite a while already. Of course, the latest one will be here. So here we will have updates from your last week recap to our updates for the economic calendar. So we will do highlight the ones that are going to more likely to create fluctuations or in the markets and so on. So we have a commentary. They even have a corporate earning and TA section. So if this is something that you find value in, do give us a shot. Have a read. And of course, if any feedback, you can always email us at cfd@phillip.com. Okay, lastly, we'll be talking about the promo. So obviously good things must share, right? So actually, this promo has been around for quite a while, right? But they extended it until end of the year. This promo is very simple. You can get up to currently now, since it's November and December, so 2 months, so $240 of cash credits when you trade FX CFD. So simple. If you trade 8 FX trades, you're able to get $20 CFD cash credit. So 8 FX trade means you just need to buy four times and you close it. So buy one, sell one equates to 2 trades. So actually it's quite easy if you think about it. Or if you do another 28, so in total 36 of FX CFD trades, then you will get $120 of CFD cash credits. So this will be credited the next month. So if you do this month, you get 120. Then next month it will reset. Then you can do it again next month. So this one opens to all clients, all platforms. You can use it do it on Poems, or you can do it on MT5, no problem. Just make sure that if you do it on MT5, do the 36 on the MT5. And now, just in case you do not have a Poems account, you can scan this QR code or go to our website and register. Okay, then this will come to our Q&A section. Feel free to, ask your questions in the chat, and I will have a look and we can answer a couple questions. Okay, I have a question here. So why is it called FX CFD? So FX actually can be traded on all kinds of instruments, be it spot FX or futures FX. But the one we provide is called CFD FX. Is there a big difference between what we do and what other FX brokers do? No difference. Because we're still doing the same thing, FX, we're still doing the quotes, we still do not have comms, we don't have finance charge, and we also have swap points, same as other brokers. So that because we are the CFD department, a contract for difference, so obviously the FX we do will be classified under contract for difference. But FX, CFD, and other FX, especially the spot FX, has no difference. Just that from different brokers, sometimes they are, especially the overseas brokers, they may be able to support, let's say, higher leverage and so on, which Singapore MAS do not allow. Yeah, some brokers can go up to what 250 times. Those are a bit, in Singapore is illegal. If you have any more questions, feel free to, if you don't want to ask now, you can always email us. We'll be happy to answer your questions. Even, through phone call also can to our dealing desk. We always have someone manning the dealing desk 24/5. So, anytime, you have any questions, especially you're trading, you want to know more about the product, feel free to call in or email in. We will attend to you as fast as we can. No worries. Yes, okay, I have another question, which there's no charges to trade FXCFD, only swap points. Yes, technically, if you don't count the spreads as a charge, technically it's not a charge. It's just a spread. So yes, swap points is the only thing that there's a markup. Yes. Yeah. No comms, no FC. That's like pretty standard at this point. But swap points is the one thing that you need to take note of. And also the spreads, which our spreads are, I will confidently say, very tight. Okay, so the spreads, right? So spreads means the difference between the bid and the ask price. So as you know, that's your cost. So let's say you open and you close at the same time, then you will incur the bid ask spread. So obviously, if it's very thin, you don't really feel it. But then if it's very thick, very big, let's say 10 pips, then obviously sometimes your price may not trigger because CFD is based on bid and ask. So you buy on the ask, sell on the bid. So having a thin spread would mean that, number one, your price is able to execute much easier because the spread are thin. So you hit your price much more faster. Let's say the middle price is the true price. Then if your spreads are very thin, that means the chance of you executing your order is much higher. And also when you close the position, you don't incur so much so-called transaction cost. That's the spread. Yeah. Yes. Actually, I can even show you this. Actually, in our poems, say FX, right? Say we pick any pair, AUD, USD. See? will show you the spreads 0.5, 0.4. So here will even show it, and this is in pips. So 0.5 pips, which is equals to about 0.5 US dollar, 0.4 US dollar. So that is if you buy and sell at the same time. That's your spread. Yep. So you can actually see the spreads. Even right here for you lah. Simple, don't need you to like try and like snapshot and try and minus this. So even they state it out for you. Yeah. Yep. Okay. If there's no more questions, and now it's also 7:30. So when you trade X, okay, for FX, CFDs, you can set cut loss, exit, or what you call stop loss. Yes, we have that order type. Just to do a stop limit order, is our stop loss order type. Of course, if you trade on MT5, there's even more advanced order types there, where you can adjust your stop loss, take profit much easier, and it's actually much more better for traders. So you can do check out our MT5, MetaTrader 5. Yes, way better tools and a better platform for more sophisticated traders that really demand that advanced order types and also chartings and so on. So you can do check out. We also have our demo account for MT5. Yes, MT5 is not chargeable. It's a free platform. Of course, you can just try out a demo first. I mean, we encourage you to try. Then if you like it, then you fund and you trade. But if you don't like it, then that's fine as well. That's why we have the demo for you to try. So you can try your buy sell, whether it's smooth, whether the prices are really what we say we are. You check it out. Yeah. Our demo accounts are free. Don't need money, you can try. And it's the same price as our live. Yep. Okay, I think with this, we can wrap up our webinar. Thank you everyone for joining today's webinar. And I hope everyone have a good evening. And anything, just email us. No worries. Okay, thank you everyone.